Question 1. Topic: Role of deductibles in home insurance. In the context of home insurance, how does choosing a high deductible typically affect both the premium and the policyholder's out-of-pocket expenses when a claim is made? A high deductible leads to a higher premium but lower out-of-pocket expenses during a claim. B. A high deductible results in a lower premium and higher out-of-pocket expenses during a claim. C. A high deductible results in both a higher premium and higher out-of-pocket expenses during a claim. D. A high deductible results in a lower premium and lower out-of-pocket expenses during a claim. Answer: B. A high deductible results in a lower premium and higher out-of-pocket expenses during a claim. Explanation: when a policyholder opts for a high deductible, they are agreeing to cover a greater portion of the cost in the event of a claim. This results in a lower monthly premium because the insurer is taking on less risk. However, if a claim occurs, the policyholder must pay the higher deductible amount before the insurance coverage begins. This trade-off helps lower overall premium costs but increases the financial burden during a claim. Relevant rule: the deductible is the amount the insured must pay out of pocket before the insurer pays any costs. Higher deductibles reduce premiums because the insurer pays less in the event of a claim. This is a fundamental concept in risk management. Question 2. Scenario-based. Topic: Filing a homeowner's insurance claim. Mrs. Thompson discovers that her home has been burglarized while she was away on vacation. Several valuable items were stolen, including her jewelry and electronics. She has the standard homeowner's insurance policy with a deductible of $1,000. The total value of the stolen items is $8,000. What should Mrs. Thompson do next, and how much compensation can she expect from her insurer? A. File a police report and submit a claim. She will be compensated $8,000 in full. B. File a police report and submit a claim. She will be compensated $7,000 after her deductible. C. She should report the theft, but she cannot file a claim since stolen items are not covered under standard homeowner's policy. D. Submit a claim without involving the police. She will be compensated $6,000 after the deductible. Answer: B. File a police report and submit a claim. She will be compensated $7,000 after her deductible. Explanation: Mrs. Thompson must first file a police report as required by most insurance policies in theft situations. Then she should submit a claim to her insurance company. Her policy likely covers stolen items like jewelry and electronics, but after her deductible of $1,000 is applied, she will receive $7,000 in compensation. Relevant rule: standard homeowners policies cover theft under personal property coverage, but the deductible applies to the claim. Filing a police report is often mandatory to ensure the validity of the claim. Question 3. Topic: Oregon Fair Plan, Fair Coverage. Which of the following is true regarding the Oregon FAIR plan, which provides access to insurance for high-risk homeowners? A. The FAIR plan is available to all homeowners regardless of their insurance history. B. The FAIR plan offers the same coverages, a standard homeowner's insurance policy, but at low premiums. C. The FAIR plan is only available to homeowners who have been denied insurance by traditional insurers due to high risk. D. The FAIR plan does not cover fire damage, only wind and hail. Answer: C. The FAIR plan is only available to homeowners who have been denied insurance by traditional insurers due to high risk. Explanation: the Oregon FAIR plan is designed to provide insurance for homeowners who are considered high risk and are unable to obtain coverage through traditional insurance providers. It acts as a last resort for those who have been denied standard homeowners insurance. The coverage offered is generally more limited, and the premiums may be higher due to the increased risk profile of the insured property. Relevant rule: the FAIR plan, Fair Access to Insurance Requirements, is a state-mandated program to ensure that homeowners in high-risk areas or with previous claims can still access insurance, but they must first prove they have been denied by traditional insurers. Question 4. Topic: Replacement cost versus actual cash value (SEV). When determining a settlement for a covered loss, what is the main difference between replacement cost (RC) coverage and actual cash value (SEV) coverage? A. ACV pays the full replacement cost of the damaged property, regardless of depreciation. B. RC deducts depreciation, while a CV reimburses the policyholder for the full replacement value of the item. C. RC reimburses the policyholder for the full cost to replace the damaged property without deduction for depreciation, while a CV takes depreciation into account. D. ACV and RC provide the same settlement value in all cases. Answer: C. RC reimburses the policyholder for the full cost to replace the damaged property without deduction for depreciation, while a CV takes depreciation into account. Explanation: replacement cost. RC coverage reimburses the policyholder for the cost to replace the damaged property without deducting for depreciation. Actual cash value. CV coverage, on the other hand, accounts for depreciation by paying the current value of the damaged property, factoring in wear and tear or age. Thus, RC provides more comprehensive compensation than ACV. Relevant rule: AE equals replacement cost, depreciation. RC policies ensure that the insured can replace lost or damaged items with new ones, while ACV only reimburses the current market value of those items. Question 5, scenario-based. Topic: Oregon Fair Claims Practices. Mr. Carter submits a claim to his home insurance company after a severe storm damages his roof. The insurance company delays investigating the claim for 60 days and then denies it without explanation. Which of the following best describes the insurer's conduct under Oregon's Fair Claims Practices? A. The insurer acted properly because it has the right to investigate for as long as needed. B. The insurer violated Oregon's Fair Claims Practices by not promptly investigating and by failing to provide a valid reason for the denial. C. The insurer has no obligation to explain why a claim is denied. D. Oregon law allows insurance companies 90 days to investigate claims before taking action. Answer: B. The insurer violated Oregon's Fair Claims Practices by not promptly investigating and by failing to provide a valid reason for the denial. Explanation: under Oregon's Fair Claims Practices laws, insurers are required to act promptly and fairly when handling claims. Delaying a claim investigation for 60 days and failing to provide an explanation for denial violates these laws. Insurers are also required to provide a reasonable explanation for any denial based on the terms of the policy and the facts of the claim. Relevant rule: Oregon Revised Statute 746.230 outlines unfair claims settlement practices, including unreasonable delays and failure to provide explanations for claim denials. Question 6. Topic: Ordinance or law coverage. Why is ordinance or law coverage important in a homeowner's insurance policy, especially for older homes? It covers the full cost of bringing a home up to code after a loss, even if building codes have changed since the home was constructed. B. It covers minor repairs that do not affect the home's overall structure. C. It is only applicable if the homeowner is also filing for personal injury claims. D. It allows the homeowner to choose not to bring the home up to code and pocket the difference. Answer: A. It covers the full cost of bringing a home up to code after a loss, even if building codes have changed since the home was constructed. Explanation: Ordinance or law coverage is crucial for older homes because building codes often change over time. After loss, even if the damage is repaired, the home must be brought up to current codes. This coverage helps pay for the additional expenses incurred due to code upgrades that standard policies may not cover. Relevant rule: homeowners insurance typically only covers the cost of repairing the damage to the condition before the loss, but ordinance or law coverage extends that to cover compliance with updated building codes. Question 7. Topic: Common liability exclusions. Which of the following scenarios would most likely not be covered under the personal liability portion of a homeowner's insurance policy? A. A guest trips and falls on the homeowner's icy sidewalk and sustains a broken arm. B. The homeowner's dog bites a neighbor's child, resulting in medical expenses. C. The homeowner starts a business in their home and a customer sues for injuries sustained while on the premises. D. A tree from the homeowner's yard falls onto a neighbor's car during a windstorm, causing damage. Answer: C. The homeowner starts a business in their home and a customer sues for injuries sustained while on the premises. Explanation: most homeowners insurance policies exclude coverage for business-related activities conducted on the premises. If a homeowner runs a business from home, they would need separate business liability coverage to protect against claims made by customers or clients. The other scenarios involving personal liability are typically covered under a standard homeowner's policy. Relevant rule: homeowners' policies generally exclude claims related to business operations conducted from the insured residence, requiring separate business insurance for such risks. Question 8. Topic: Earthquake and flood insurance. Standard homeowners insurance policies typically exclude coverage for earthquakes and floods. How can homeowners in Oregon protect their properties from these perils? A. By adding an earthquake endorsement to their existing policy and purchasing a separate flood insurance policy. B. By purchasing an umbrella liability policy which covers all types of natural disasters. C. By relying on state and federal disaster relief programs to cover these events. D. By upgrading their standard homeowners insurance to include earthquake and flood coverage automatically. Answer A. By adding an earthquake endorsement to their existing policy and purchasing a separate flood insurance policy. Explanation: homeowners can add an earthquake endorsement to their existing policy to cover earthquake damage, but flood coverage must be purchased separately through the National Flood Insurance Program (NFIP) or private insurers. Standard homeowners insurance policies do not automatically include coverage for these natural disasters. Relevant rule: standard homeowners policies exclude earthquake and flood damage, so separate coverage is needed. The NFIP provides flood insurance, while earthquake coverage can be added via an endorsement. Question 9. Topic: Subrogation and salvage rights. If a homeowner's insurance company pays a claim for damage caused by a third party, what rights does the insurance company typically acquire? A. The right to file a lawsuit against the homeowner for negligence. B. The right to recover the amount of the claim from the third party responsible for the damage. C. The right to deny all future claims from the homeowner. D. The right to salvage and sell the homeowner's undamaged property. Answer: B. The right to recover the amount of the claim from the third party responsible for the damage. Explanation: subrogation allows an insurance company to seek reimbursement from a third party that is responsible for a loss after the insurer has paid the policyholder's claim. This right ensures that the insurer can recover costs if another party is legally liable for the damages. Relevant rule: subrogation rights allow the insurer to step into the shoes of the insured to recover damages from a third party responsible for the loss. Question 10. Topic: Bodily injury and property damage liability. Which of the following would be covered under the bodily injury and property damage liability section of a standard Oregon homeowners policy? A. A contractor hired to repair the homeowner's roof falls and injures themselves. B. A tree on the homeowner's property falls onto their own cart during a storm. C. A delivery person slips and injures themselves on the homeowner's front steps. D. The homeowner trips over their own child's toy and breaks their arm. Answer: C. A delivery person slips and injures themselves on the homeowner's front steps. Explanation: liability coverage under a homeowner's insurance policy covers bodily injury and property damage claims made by third parties, such as a delivery person who slips on the homeowner's property. Injuries to the homeowner or their family members or damage to the homeowner's own property are typically not covered under the liability portion of the policy. A relevant rule: homeowners liability coverage protects the insured from claims made by others, third parties, for bodily injury or property damage caused by the insured's negligence. Question 11. Topic: Dwelling versus other structures coverage. In a standard homeowners insurance policy, what is the main difference between dwelling coverage and other structures coverage? A. Dwelling coverage insures both the home and any outbuildings, while the structures coverage is for landscaping. B. Dwelling coverage protects the physical structure of the home, while the structures coverage protects detached structures such as sheds, fences, and garages. C. Other structures coverage is only for items inside the home, while dwelling coverage applies to anything on the property. D. Dwelling coverage is for natural disasters, while the structures coverage is for vandalism. Answer: B. Dwelling coverage protects the physical structure of the home, while the structures coverage protects detached structures such as sheds, fences, and garages. Explanation: dwelling coverage provides protection for the main structure of the home, while the structures coverage applies to detached buildings on the property, such as garages, fences, or sheds. Each has its own coverage limits within a homeowner's policy. Relevant rule: dwelling coverage is for the primary home, while other structures typically covers detached buildings and structures. Question 12. Topic: Personal property replacement cost. If a homeowner has personal property replacement cost coverage and their 5-year-old television is stolen, what will the insurer pay? A. The depreciated value of the television based on its age. B. The current market value of a 5-year-old television. C. The full cost of replacing the television with a new one of similar make and model. D. Nothing, because electronics aren't covered under standard homeowners insurance. Answer: C. The full cost of replacing the television with a new one of similar make and model. Explanation: with personal property replacement cost coverage, the insurer will pay the amount needed to replace the stolen item with a new one of comparable quality. This differs from actual cash value SEV coverage, which would take depreciation into account. Relevant rule: personal property replacement Cost coverage reimburses the insured for the cost to replace items without considering depreciation. Question 13. Topic: Fire Department Service Charge Coverage. Which of the following best describes fire department service charge coverage in a homeowner's policy? A. It pays for the fire damage to the property. B. It covers the cost of damages caused by the fire department while extinguishing a fire. C. It reimburses the homeowner for the fees charged by a fire department for responding to a fire at their property. D. It pays for the costs of replacing fire extinguishers and smoke alarms after a fire. Answer: C. It reimburses the homeowner for the fees charged by a fire department for responding to a fire at their property. Explanation: Fire department service charge coverage pays for the fees some fire departments charge for responding to a fire. This coverage is generally included in standard homeowners policies and covers up to a specified limit. Relevant rule: this coverage applies when a fire department outside a homeowner's local area, usually in rural locations, responds and charges a fee for its services. Question 14. Topic: Loss of use coverage. After a fire destroys part of Mrs. Lynn's home, she is unable to live there while repairs are made. What will the loss of use coverage in her homeowner's policy help pay for? A. The cost to repair the damage to her home. B. The increased cost of living expenses such as hotel stays and meals while her home is being repaired. C. The cost of her mortgage payments during the repair period. D. The cost to replace her personal belongings lost in the fire. Answer: B. The increased cost of living expenses, such as hotel stays and meals, while her home is being repaired. Explanation: Loss of use coverage helps pay for additional living expenses incurred by the homeowner while their home is being repaired and they cannot live there. This includes costs such as hotel bills, meals, and temporary rentals. Relevant rule: this coverage applies only if the loss is caused by a covered peril. Question 15. Topic: Liability limits. Which of the following statements is true regarding liability limits in a homeowner's insurance policy? A. Liability limits are unlimited, covering all costs regardless of the claim's amount. B. The policyholder can choose the liability limit, but it usually starts at $100,000. C. Liability limits only apply to medical expenses, not legal fees or settlements. D. Liability limits only cover damage to the homeowner's own property. Answer: B. The policyholder can choose the liability limit, but it usually starts at $100,000. Explanation: Liability limits in homeowners insurance policies can be chosen by the policyholder and typical starting amounts are $100,000. This coverage applies to third-party bodily injury or property damage claims, including legal defense costs. Relevant rule: liability limits in homeowners policies protect the insured from claims and lawsuits for injuries or damages they may cause to others. Question 16. Topic: Medical payments to others. Under the medical payments to others coverage in a homeowner's insurance policy, which of the following scenarios would typically be covered? A. The homeowner trips on their own stairs and requires medical attention. B. A guest visiting the homeowner's property falls and sprains their ankle. C. The homeowner's child falls off their bike in the yard and needs stitches. D. The homeowner's dog bites the homeowner and requires medical care. Answer: B. A guest visiting the homeowner's property falls and sprains their ankle. Explanation: Medical payments to others coverage is designed to pay for minor medical expenses if a guest or other third party is injured on the homeowner's property regardless of fault. This coverage does not apply to injuries sustained by the homeowner or their family members. Relevant rule: medical payments coverage typically covers up to a set limit for injuries to non-residents on the property. Question 17. Topic: Windstorm and hail exclusions. Which of the following properties would most likely require a special endorsement or separate policy for windstorm and hail coverage? A. A condominium in Oregon. B. A beach house on the Oregon coast. C. A farm located in eastern Oregon. D. A commercial building in downtown Portland. Answer: B. A beach house on the Oregon coast. Explanation: homes located in coastal areas, such as a beach house, are more vulnerable to windstorm and hail damage. Many standard homeowners policies exclude windstorm and hail damage for properties in high-risk areas, requiring the homeowner to purchase additional coverage. Relevant rule: special endorsements or policies are often needed for coastal properties due to higher risk of storm damage. Question 18. Topic: Vacant home exclusion. Mr. Wilson's home has been unoccupied for 6 months and it is damaged by vandalism. Which of the following is most likely true regarding coverage under his homeowner's policy? A. His policy will provide full coverage for the damage as long as it was reported promptly. B. His policy will deny the claim due to the vacancy exclusion. C. His policy will only cover half of the cost of the damage. D. His policy will cover the damage, but he will need to pay an additional deductible. Answer: B. His policy will deny the claim due to the vacancy exclusion. Explanation: many homeowners insurance policies have a vacancy exclusion, meaning they will not cover certain losses, such as vandalism, if the home has been vacant for a set period, typically 30 to 60 days. After that period, additional coverage may be required for vacant properties. Relevant rule: a home is considered vacant when it is unfurnished and uninhabited for an extended period, triggering coverage restrictions. Question 19. Topic: Home business exclusion. Jane operates a small business out of her home. A customer is injured while visiting to pick up an order. How will a homeowner's insurance likely respond? A. It will cover the customer's injury under personal liability. B. It will deny the claim due to the business exclusion. C. It will cover the claim but at a reduced limit. D. It will cover the claim only if Jane has an umbrella policy. Answer: B. It will deny the claim due to the business exclusion. Explanation: standard homeowners policies typically exclude claims related to business activities conducted from the insured residence. To be covered for such incidents, Jane would need a separate business insurance policy or a home business endorsement. Relevant rule: business activities are generally excluded from personal liability coverage under homeowners policies. Question 20. Topic: Identity theft coverage. How does identity theft coverage in a homeowner's insurance policy typically protect the insured? A. It reimburses the insured for the full amount of stolen funds. B. It covers the cost of legal fees and expenses to restore the insured's identity. C. It replaces credit cards that have been stolen. D. It provides automatic security monitoring services. Answer: B. It covers the cost of legal fees and expenses to restore the insured's identity. Explanation: identity theft coverage helps pay for expenses associated with recovering the insured's identity after it has been stolen. This can include legal fees, notary fees, and other costs incurred to restore the insured's financial standing. Relevant rule: this coverage is typically offered as an endorsement and does not reimburse for stolen funds directly but helps with recovery efforts. Question 21. Topic: Scheduled personal property endorsement. Which of the following situations would be most likely covered by a scheduled personal property endorsement on a homeowner's insurance policy? A. A fire damages your kitchen and you need repairs. B. A valuable piece of jewelry is stolen from your home. C. Your roof is damaged by hail. D. Your home's foundation begins to crack over time. Answer: B. A valuable piece of jewelry is stolen from your home. Explanation: a scheduled personal property endorsement provides additional coverage for high-value items like jewelry, art, or collectibles, which may not be fully covered under a standard homeowner's policy. These items are often scheduled listed, with specific coverage limits based on appraisals. Relevant rule: standard homeowners policies may have limits on certain items like jewelry, making endorsements necessary for full coverage. Question 22. Topic: Earthquake coverage. Which of the following statements about earthquake coverage in a homeowner's insurance policy is accurate? A. Earthquake coverage is automatically included in standard homeowners policies. B. Earthquake coverage must be purchased as a separate policy or endorsement. C. Earthquake damage is only covered if the earthquake was minor. D. Earthquake coverage is included, but it requires a deductible that equals half the home's value. Answer: B. Earthquake coverage must be purchased as a separate policy or endorsement. Explanation: most standard homeowners insurance policies do not include earthquake coverage. Homeowners who want coverage for earthquake-related damage must purchase it as an endorsement or separate policy, depending on the insurer. Relevant rule: earthquake coverage is optional and typically has a separate, higher deductible. Question 23. Topic: Flood insurance. Why is flood damage not covered under a standard homeowner's insurance policy? A. Flood damage is always considered a maintenance issue. B. Floods are considered too common to insure under standard policies. C. Flood damage is covered by a separate government-backed program through the National Flood Insurance Program (NFIP). D. Floods only affect certain regions, so coverage is only available through regional policies. Answer: C. Flood damage is covered by a separate government-backed program through the National Flood Insurance Program (NFIP). Explanation: flood damage is not covered by standard homeowners insurance policies. Homeowners must purchase flood insurance separately through the National Flood Insurance Program (NFIP) or a private insurer if they want coverage for flood damage. Relevant rule: flood insurance is a separate policy and is especially important in flood-prone areas. Question 24. Topic: personal liability exclusion. Which of the following scenarios is most likely excluded from personal liability coverage under a homeowner's insurance policy? A. A guest slips and falls on the homeowner's icy driveway. B. The homeowner's dog bites a neighbor while they are visiting. C. The homeowner injures someone in a car accident while driving their own vehicle. D. The homeowner accidentally damages a neighbor's fence while mowing the lawn. Answer: C. The homeowner injures someone in a car accident while driving their own vehicle. Explanation: personal liability coverage in a homeowner's policy typically excludes incidents involving motor vehicles. Car accidents would be covered under an auto insurance policy, not a homeowner's policy. Relevant rule: homeowners insurance covers personal liability for bodily injury and property damage except in situations like auto accidents, which require separate coverage. Question 25. Topic: ordinance or law coverage. What does ordinance or law coverage in a homeowner's insurance policy typically protect against? A. Increased costs to rebuild a home due to new building codes or ordinances. B. Legal fees associated with property disputes. C. Fines imposed by local governments for code violations. D. Losses incurred due to trespassing or vandalism on the property. Answer: A. Increased costs to rebuild a home due to new building codes or ordinances. Explanation: ordinance or law coverage helps cover the additional costs of bringing a damaged or destroyed home up to current building codes or ordinances during a rebuilding or repairs. This type of coverage is essential if local building codes have changed since the home was originally constructed. Relevant rule: without this coverage, homeowners may have to pay out of pocket to meet updated building standards after a loss. Question 26. Topic: replacement cost versus actual cash value (SCV). Which of the following best explains the difference between replacement cost and actual cash value (SCV) coverage? A. Replacement cost covers the cost of repairs minus a deductible, while a CV pays for repairs plus depreciation. B. Replacement cost pays for the full cost to repair or replace property without depreciation, while a CV pays for the depreciated value of the property. C. Replacement cost only applies to personal property, while a CV only applies to structural damage. D. Replacement cost and a CV are the same, but a CV has a lower deductible. Answer: B. Replacement cost pays for the full cost to repair or replace property without depreciation, while a CV pays for the depreciated value of the property. Explanation: replacement cost coverage reimburses the homeowner for the full cost to replace or repair property without taking depreciation into account, while actual cash value (SCV) coverage reimburses for the depreciated value, accounting for age and wear and tear. Relevant rule: the choice between replacement cost and SCV affects how much a policyholder will be reimbursed after a loss. Question 27. Topic: homeowners insurance deductibles. A homeowner's insurance policy has a $1,000 deductible. If a windstorm causes $10,000 worth of damage to the home, how much will the insurance company pay? A. $10,000. B. $9,000. C. $8,000. D. $1,000. Answer: B. $9,000. Explanation: the deductible is the amount the homeowner is responsible for paying before the insurance company pays the rest of the claim. In this case, the homeowner would pay the first $1,000 and the insurance company would pay the remaining $9,000. Relevant rule: deductibles apply to claims, and higher deductibles generally result in low premiums. Question 20. Topic: additional living expenses. Which of the following expenses would typically be covered by the additional living expenses provision of a homeowner's insurance policy? A. Repairs to the home after fire. B. Medical bills for an injury sustained on the property. C. Temporary housing costs while the home is being repaired after a covered loss. D. Replacing stolen personal property. Answer: C. Temporary housing costs while the home is being repaired after a covered loss. Explanation: the additional living expenses provision helps cover the increased costs of living, such as hotel stays, meals, and temporary housing when a policyholder cannot live in their home due to a covered loss, such as a fire. A relevant rule: ALE coverage is generally limited to a specific dollar amount or duration depending on the policy. Question 29. Topic: Water backup and sump pump overflow endorsement. Which of the following perils would most likely be covered by a water backup and sump pump overflow endorsement? A. A burst pipe causing water damage to the kitchen. B. Flooding from a nearby river. C. Water damage caused by a backed up drain in the basement. D. Heavy rain causing a roof leak. Answer: C. Water damage caused by a backed up drain in the basement. Explanation: water backup and sump pump overflow endorsements cover damage caused by water backing up through drains or a malfunctioning sump pump. This endorsement is necessary because water backup is typically excluded from standard homeowners policies. Relevant rule: this endorsement is separate from flood insurance and covers specific types of water damage. Question 30. Topic: Prohibited use coverage. In which situation would prohibited use coverage in a homeowner's insurance policy most likely apply? A. The home is damaged by a hurricane and declared uninhabitable by local authorities. B. The homeowner is prohibited from living in their home due to unpaid taxes. C. A neighbor sues the homeowner for trespassing. D. The homeowner is prohibited from renovating their property due to zoning laws. Answer: A. The home is damaged by a hurricane and declared uninhabitable by local authorities. Explanation: prohibited use coverage provides additional living expenses when a government authority prohibits the use of a home due to nearby damage, such as after a natural disaster. This coverage applies even if the home itself was not directly damaged. A relevant rule: this coverage can be essential in disaster situations where homeowners are forced to evacuate their homes.